in terms of this geopolitical risk, how do you evaluate it? We've seen some of the expected trades coming through, you know, towards the yen and towards gold. Does this have long-lasting implications, though, this heightened geopolitical tension that we see at the moment?
Look, I think it's coming at a time when volatility was incredibly low, risk assets were very, very high, and I'd say also some of the fundamentals. If you look at, say, the PMIs in Europe, which had been at 7-year highs, we saw last week those just came off those 7-year highs, a little bit disappointing for June, and even earnings momentum, when you look at the market, we'd seen upgrades, but again, June was basically flat. So I think the fundamental picture, tactically, not strategically, but tactically, was probably getting a little bit worse, and then you throw on the far, as it were, some, geopolitical concerns, and your starting point with as I said, VIX and those other assets quite, pricing in not much risk, you can see a tactical pullback.
Well, look, this is the debate. Yesterday, Goldman's, one of the most read stories, that it's going to take a war or recession to knock volatility up. Today, let's have a look at the VIX and the V stocks, because they are moving. But the cost of hedging, vol is low, but the cost of insuring yourself on the S&P is ratcheting higher. Nearly 2.7 calls traded for each put. That is the most since 2007. 4-to-1 on the call to put ratio, the highest since 2014. The cost of insuring myself is beginning to spike higher. Now, when I speak to UBS, normally they say, oh, you don't want to spend money on insurance, a waste of money, you want to be fully involved in the market. Maybe that was the wealth management side. But it's an uneasy time in the world.
Yeah, JP Morgan also saying brace for less.
Brace.
Times. Yeah.
Well, look, I think also, one of the reasons VIX implied vol is so low is because realised vol is low, right? The S&P 500 is not moving up or down 2 or 3% a day, right? It's been in a very, very narrow range.
Yes.
So that's just effectively a mathematical achievement that's coming out of that. I think when you look at the situation we've been in terms of where markets are, having had a great run since last summer. Think back to June last year after the Brexit vote, Treasury yields down at 130. This wasn't lower for longer; it was lower forever, right? So we've moved away, and bond yields have normalised somewhat to some degree. We've seen better economic growth come through. We've certainly seen profits turn in Europe. That's been the big story for us in the last 12 months. So I think we're in a better place strategically than we were a year ago. But clearly we've moved quite a long way quite quickly.